Module 5, guys. We're pretty much halfway through this course. We're not doing bad. We're not doing bad at all. How long have I been live? Damn, 2 hours almost. All right. So, Module 5. Hopefully I can do this before my kids get home from school. Module 5, cash flow from options, sell puts like a pro. This is where it starts to get fun, Josue. So, we are going to focus for now only on selling puts, all right? So, we're going to simplify this. Again, options are contracts that give you the right but not the obligation to buy or sell a stock at a specific price. We focus only on selling puts, not buying options. We will focus on another strategy as a backup in case this doesn't work, our initial strategy doesn't work out. Because when you sell puts, and let's say you don't get to your strike price, then you're going to be assigned shares. And we'll explain that in just a bit. The reason why we only sell puts is because you get to collect a premium up front. All right. So, and I'll break that down in just a bit. You get paid to buy stock you already wanted at a discount. It is important, guys, that we only sell puts on companies that we like. And I'm going to show you guys how to find great companies. I'm going to show you how to read financials, how to evaluate a company, and how to know that that's a great company to invest in. All right. So we're not buying individual stocks, but we will buy them if we get assigned those stocks when we're selling puts. Okay. So we're going to get paid to potentially buy the stock we already wanted at a discount. It's a win-win. Think of it as being the house in a casino instead of being the gambler. People say all the time, oh, options is gambling. No, not if you're sitting on the other side of the transaction. You get to be the casino, all right? So what is a naked put and why does it pay you? A naked put is when you sell a put option without owning the stock yet, but you have the cash ready to buy if you are assigned, all right? So how it works, you sell a put at strike price. You sell a put at a strike price that you're willing to buy the stock at. You get paid up front the premium, just like selling insurance. If the stock drops below the strike, you're assigned the shares. So here's an example. Let's say the stock is worth $105. Right now, we go to the stock market. Let me see. I'm going to use a real example for you guys because I wish somebody would have done this for me when I was learning. Give me a second here. What's a good stock? Let's go with SoFi. All right. So we're going to SoFi here, and on the top right corner here, I'm going to click on the options chain. You guys can see it's already preset puts and sell. Okay. Now, if we come down here, let's just go here. If we scroll down, we know that this stock is priced at $14. So the stock in this example is $105, but SoFi is $14. I'm going to put $14.23. All right. The strike price that we choose is up to you, but let's just say it's $14 and we're going to choose the $12.50 strike price for whatever reason. The premium of the $12.50 strike price is 22 cents. Do you guys see that? It's 22 cents a share. 22 cents a share times 100, because remember, one contract is 100 shares. That would mean, let's click on it. If I go to one quantity, and let's just put market for now, that means I'm going to get paid $21 immediately if I do this trade. All right. And in the course, I have it typed here. So the stock price is right now is valued at $14. The strike we chose is $12.50. The premium is 22 cents a share. Okay. $22. So I'm going to get paid $21 in premium. That's what somebody's going to pay me in insurance for one contract. But that's not enough for me. So I'm probably going to do like 30 contracts. And now my premium, somebody's going to pay me $640 for this premium. Okay. If I do this trade, I will get the $640 up front. Okay. So let me put, in this example, it's $22 up front. All right. But remember, I decided to do 30 contracts, and that equals $640. So if the stock stays above $12.50, okay, I get to keep the $640. All right. If the stock drops below $12.50, I have to buy 100 shares at my strike price, which is $12.50, but my cost basis is really, $12.50 minus 22 cents because I already collected the premium up front, remember? So this is $12.28. Hopefully I didn't lose you. Okay? Because remember, when we sold these contracts, when we sold these puts, okay, we collected the 22 cents a share up front. Hopefully I'm not confusing you guys. I know it's a lot. I'm trying to be as descriptive as possible. All right, cool. All right, that sounds right. Okay, so you either get paid or you get a great company at a discount because we are only buying companies that we love. So what we're saying is if we can buy SoFi at $12.50, after looking at the financials and being informed on how good that company is, we're happy either way because either we got paid for insurance or we got paid and we got a great company at a discount. It's a win-win situation long term. This is why you don't sell options, you don't sell puts on shitty companies. Then you get screwed. Here's the difference though. When you sell options on shitty companies, you make more per contract. So a shitty company might pay me $1,200 versus $640. But we are trying to manage risk. We're trying to do this long term and we're trying to win. So we don't do that. Okay? So you only sell puts on companies you'd be happy to hold long term that have proven growth and cash flow. And I'm going to show you guys how to prove it. That have fair or undervalued based on metrics like PE ratios. I'm going to teach you how to do that. That are a durable brand that have moats and economic advantage. I'll teach you that. This isn't gambling. It's a strategic ownership. If you don't want to own the stock, don't sell the put. Okay? Now, margin accounts and how to use them without fear. This is why we're doing level 3 options because we want a margin account. We're going to use leverage. But we're going to use leverage after we know we make good money. That's why module 1 was your gig, your job is the most important thing here. All right. So we need margin so that we can sell naked puts. You need a margin account. Even if you don't use borrowed money, you still need a margin account to sell puts. Margin isn't dangerous if you keep 100% of the cash collateral in your account. You only sell puts on high quality stocks and you never go beyond your buying power. And we'll teach you guys how to look at that as well on Fidelity. Margin gives you speed and access, not risk, unless you overextend. Think of it like a permission slip, not a credit card. Okay? How to reinvest the premium into your base portfolio. So remember, you collect the premium up front. Now, some people would take the premium and collect it up front and immediately go reinvest it into their base. So remember, in module 2 and module 3, we talked about your base, okay? So this is what it looks like. You have your main income, however it is that you make that, okay? It goes into your brokerage, into your base. That base is VOO and QQQ, okay? From there, you're going to take margin and you're going to start selling puts. The premium that you collect, okay, is going to be reinvested into your base. So you're double dipping on returns. And it's just a cycle that you're going to continue doing. You're going to dollar cost average and you're going to invest the premiums into your base because long term, this is your wealth builder. Now, some people will do it right away as soon as they collect their premium. I like to do realized premiums, okay? So not until I close my position or buy to close is what they call it, or buy to close, I'm not going to reinvest the premium until I buy to close. That's just my way of doing it. It's not necessary because there's ways to make sure you're profitable no matter, long term, no matter what. but I just like to be, like to have real money that's invested, realized gains that's reinvested into my base. Okay. So you reinvest into your base. I don't put and, I put and, or, I don't put or, I put and. So I'm going to put and or use it to dollar cost average into stocks you already love. No, I'm going to put, you could do or. I just do the base portfolio. I'm not doing it into stocks that I already love. I'm going to sell puts on stocks that I already love. Okay. So this creates the flywheel. And that's what this is. This is the flywheel right here. This is the flywheel that we're going to create. Isn't it genius? Okay. And this, I learned this, guys, from like 10 different courses. Invest with Brandon. There's another guy who I really like. I forget his name. He's a Jewish guy. Amazing. Another one is the Swedish Investor. Another one is Carlton, who I use his Qualtrim software that I'll show you guys in just a bit. But I did the Meet Kevin investing courses. I read books like The Snowball, The Dondo, so many books on this stuff. This is 10 years of research, guys. So anyways, so the flywheel is you sell puts, you collect the cash, you reinvest into your base portfolio, you increase your buying power, because as this grows right here, guess what also grows? Your margin and your buying power, which allows you to sell more puts. So instead of only being able to have like 2 puts open, now you might be able to have 4 and then 6. Right now, like there was one point where I had 8 puts open at once. I had HIMS. I had puts sold on HIMS, on Robinhood, on SoFi, on Tesla, on NVIDIA, on TMSC or TMC. I can't remember. The Taiwan semiconductor. TSM. Sorry, TSM. And who else did I have? I had Palantir, and I forget the last one I had. But I had 8 options sold, puts sold at once, because I grew my buying power. All right. And then you can track it on your own. There's spreadsheets and stuff that you can use. You can use Notion, ask ChatGPT to create something for you. But I just use Fidelity. I just use my app and my dashboard on my desktop to track everything. So again, here's the options cash flow checklist. You need to open a margin account, level 3 approval. You need 20K funded, and identify companies that you love. I'm going to teach you guys how to identify those. You're going to use Fidelity or another brokerage that you like to sell cash secured puts or naked puts. You're going to reinvest the premiums weekly into your base, and then you're going to track the results. Okay. I can show you the results for the last, for this month so far. This is my results for this month so far. So you guys can see here, this is this month, all right? This was TSM, Taiwan's semiconductor company. I locked in 256. These are realized gains. You guys can see here, these are closed positions, okay? For this month so far. And I got to look to get into some more. I just haven't yet, but I still have a whole 2 weeks left of this month that I can make money on, okay? So the first one I locked in premium in was $256 with TSM, $568 with Tesla, $728 with SoFi, $545 with SoFi again. Shopify was another one, $653. I did have puts sold. I was testing it with indexes, but it's just too expensive for the size of my portfolio. I'll probably do more puts sold on indexes when I have more money in my account. But for now, I'm not going to do that anymore. Palantir, I made $400. NVIDIA was a long-term put that I was testing for like 2 years out. I decided to close that so that I can take that capital and put it into other opportunities, because everything's an opportunity cost. NVIDIA, I made $366 on. MSTY was more so a dividend yield max fund. That's not my style. That's not my strategy. I got excited because I was watching some YouTube videos. I decided to get out of that. It's too risky. I like my strategy. I'm sticking with it. Robinhood, I made $389. Robinhood again, I made $646. And HIMS, I made $576. So for this month so far, and guys, remember, I I started with $20,000, I think, in March. All right. Now this account's at $40,000. And this is for this month so far alone. Okay. So there's been some that I had to close early that weren't making money that I was like, man, if I can break even, I'm getting out of it. And I did. This was another one. No, VTI was just a index that I accidentally bought. But this is proof that, you know, this is the strategy that I'm using for this month so far. This is how we're looking. A lot of people won't show you that type of stuff, right? And again, my wealth is not in the stock market yet. It's in companies that I own. And you can look up my companies, tomb45.com, pieaccounting.com, floridafinestcustoms.com, 6fbmentorship.com. All of these are seven-figure companies. So I invest into my businesses first, and then we do the other stuff. I also own $4 million in real estate that I've bought in the last few years. And all of that is documented. I vlogged it on my main channel. If you're in my mentorship, the Six-Figure Barber Mentorship, you've seen me on the phone, closing the deals, sharing the contracts, everything. So I am not one of those guys that is just selling a course to people and making money. I do this shit full time, and I'm just sharing the stuff that I've learned throughout the years. So take it for what it is. Easy. We're not buying calls. We're selling puts. I'm not betting. I want to be the casino. So if you want to go do a different strategy, go learn it. But that's not what I'm doing. I don't like that strategy. And I don't like the decay. I don't like decay of buying calls. I don't like that shit. I like decay to work in my favor. So that's why I sell puts. Okay. So that is module 5, but that's not module 5. I'm sorry. That was premature. Let me show you guys what I'm looking for when I'm making a decision to get into a contract. Okay, you guys ready? I need some thumbs ups. I need some fire emojis. I need some energy. I'm here by myself. It's quiet in here. It's boring. My dog left. She went to the room, taking a nap or something. All right, I'm gonna show you guys this formula real quick. These are my requirements when I'm looking at. Show you my requirements when I'm looking for an option, a good stock to sell puts on, or when I think a put is a good purchase, I should say. Let's do Palantir. Yeah, we're getting some energy in here. Let me show you guys what I'm looking for. Hold on. Make sure this looks good. All right. So the first requirement, if I'm going to so the first requirement is to find a great company. Okay? Great company with a lot of action. Great company, or I should say a lot of volume. Okay? With a lot of volume. If it is a company with very low volume, chances are you're not gonna be like, you're gonna have issues with getting out of the position, and it's probably just not gonna be. It's not gonna meet the numbers that you're looking for in order to make a decision to get into that. So we're looking for a great company that has volume. All right. Now, a great company. I'm gonna teach you guys later how to identify a great company in the next. I think it's the next module. Okay. But as far as volume, you want. Hold on. I need to explain this a little bit easier. Oh, I don't know why it's not showing up on my phone. Oh, never mind. I got it. Okay. So here we go. I found it. All right. So if you look at right here, you guys can see VOL on this column. You'll be able to see how much volume something has, right? The lower the volume, the less people that are on the other side of the trade. You want a lot of volume so that you know you can get in and out of this trade. Okay. So great company is number 1, and it has to have volume is number 2. 1, 2. All right. Number 3 is we are looking for a delta of 0.2. Okay. A delta of 0.2. Let me show you what that looks like. So a delta is the odds that you will get assigned this contract, which means you have a 20% chance of losing this trade, and you have an 80% chance of winning this trade, okay? Notice I say around. The higher, okay, that would be a 70% chance of winning. The higher it is, the more risky it is, which means you collect more premium. So for example, on a 0.2, they might pay you $600, but on a 0.3, you might get paid $800. So that just really depends on the conviction that you have. 80% to me is conservative and is the sweet spot. If you want to go higher, like 0.19 or 0.18, that's fine too. What I would do from here is see what kind of premium you're looking at. Because if you're going to take the extra risk, you better be making a lot more money. And if you're going to take the extra risk, is because you have a lot of conviction that this trade's going to go your way. Or you don't care if you get assigned the contract because you're okay with buying that stock at that price. Some people will literally go for the higher premium because they want to be assigned the stock. They just want to get paid to buy the stock at a discount. Hopefully that makes sense to you guys. So we're looking for a 0.2 delta. How does that look? Well, if we go to the app and we go back to the options chain, remember, this is how you go to the options chain. You just look up the stock. This is Palantir. There's a chain at the very top right. Click on the chain. You want to go puts and you want to go sell. We're not buying puts, we're selling puts. We're not buying insurance, we're selling insurance. And I like, this is key, 30 to 45 days out. The reason why I like that is because it's easier for me to track it. I'm trying to earn a 2 to 3% return every month, okay? So it's easier to track this way. The other reason why is because there's a thing called decay. You can learn that later on, guys. Go YouTube it, go Google. What is decay in options? This works in your favor when you're selling puts. So the closer it gets to the expiration date, the more the value of even if, let's say that your strike price, let's use a real example. Let's say the strike price in this particular one, where am I at? So Palantir is $129, all right? If you guys see my screen, $129.71. Let's say I'm going to go to the delta, see the delta? And I'm looking for a 0.2. So the 0.2 is going to be the 115 strike price or the 116. I have a lot of conviction, but it's a bullish market. Everything went up like crazy. So I'm going to go with the 0.19. I'm going to write both of these down, okay? The strike price of 115 is going to give me, let's scroll over to the side, a $2.28 premium, where the 116, which is more risky, is going to give me a $2.47 premium. You see the difference there? All right. We have to decide which one is worth it to us. Now, the closer that we get to the expiration date, which is 30 to 45 days out, the closer you get, like, for example, if let's say you're going to collect $600 in premium, you might have 80% 15 days in because of what's called decay. So if you're still not sure with that, just Google it, watch a YouTube video on it. Trust me, do your thing with that. So again, let me just clean this up because it looks pretty confusing to me. And then we're going to go into questions, guys. Let's just erase all this. Okay. So remember, our magic number is 0.2. When we went over, what the hell am I doing? Is 0.2. When we went to 0.2, remember, 0.2 is $115 strike price. The premium I'll collect, let's do it this way to make it easier for you guys. We're going to go strike price. We're going to go premium. And we're going to go delta. All right. And we're going to go the stock price. If we go back to our course, okay, if we go back to our course and we go back to, was it this one? No. Maybe it was module 5. Yeah. All right. So remember, this was the example that we gave. That was SoFi. So this is a real example, okay? And we know that the stock price, as shown on my phone, if we go down, the stock price is $129.71. okay? We know this, the delta that we're looking for, remember, is a 0.2. So I'm going to scroll over to where it says delta, and I'm going to look for a 0.2. Oh, here we go. So 0.2 we know is the 115 strike price and the 116. So 115, the 115 strike price has a delta of, let's scroll back over. Sorry, there you go. 0.19, and the 116 has a delta of 0.21. So this one has a 81% chance of winning. This one has a 79% chance of winning. Okay, winning odds. Now let's go look at the premium, and the premium at the 115 is $2.28. Remember, there's 100 shares in one contract, so this would be times 100. The premium for the 116 would be $2.47. Remember, there's 100 contracts in one put, so that would be times 100. So these are all of our numbers. Now, what do we do with these numbers? Remember, number 4 is we want a 2 to 3% return. If you can do better, let me do this, plus return, okay? How do we calculate what our return is? This is the math, okay? Pay attention, this is the math. It's going to be 100, because there's 100 shares in a contract, divided by the strike price, multiplied by the premium. There's your formula, all right? So let's do the math here. Our strike price for the 115 is, so we're going to do 100 divided by the strike price of 115 times the premium. The premium's 2.28. Our return is 1.98. Does that meet our criteria of 2 to 3%? Kind of, yeah. It's not quite there, but you know, if you're off by 0.02%, you can go with that number if you wanted to. But if you have conviction, then let's try the 116 strike price. That's 100 divided by 116 times the premium, which again, 100 divided by 116 times the premium, okay, times 2.47. That's 2.1% return. I'll probably, if I'm going to buy this put, if I'm going to sell this put, I'm probably going to go with the 116 strike price. And honestly, if I have a lot of conviction in the trade, I might go higher than that. I might go for a 117 or 118. Or if I want to be assigned the shares, then I'll go even higher. If I think it's a good price for this stock. If I think Palantir is worth $130 right now, I'm okay with paying 116. Okay? That's if I think it's undervalued. But we have to learn, the next steps are we have to learn what makes a great company and what makes a company undervalued. We're going to have to learn that.